What the inflation means to your personal financing. Inflation is a silent thief that can steal the purchasing power of your hard-earned money. In order to make informed financial decisions, it's essential to understand inflation and its effect on one's personal finances. Actually, inflation is the rate at which prices for goods and services rise over time, and it directly affects the value of your savings, income, and investments. It's a normal and expected part of any economy, but can have significant impact on your finances if not managed properly. Over time, inflation progressively lessens the purchasing power of your hard-earned earnings, diminishing their worth. For instance, if inflation is 2% per year, the cost of living will grow by 2% per year, and like $100 items will cost $102 in the next year, which means that the same amount of money will purchase less and less over time. So, in this video, we'll discuss how inflation affects your financing and how to manage it properly. Subscribe to our channel now, and don't forget to press the bell icon. Let's get started. The effect of inflation on your personal financing. Number 1. Increase in cost of living. Inflation influences the cost of living by gradually raising the prices of goods and services. Suppose you earned $50,000 a year, and the annual inflation rate is 2%. Your annual cost of living grows by 2%, which implies that the $50,000 you make today will have less purchasing power in 1 year. Your cost of living has grown by $1,000 over the past year, and you must now earn $51,000 to maintain your present quality of life. Due to the increase in costs, the $50,000 you earned last year will not be sufficient to purchase the same goods and services as it did the year before. Number 2. Savings and investments. Over time, inflation can erode the value of your savings and investments. For instance, if you have $10,000 invested in a bond that yields 5% per year and inflation is 6% per year, your investment will be worth less in real terms. The interest earned is insufficient to compensate for the losses of buying power caused by inflation. To protect against inflation, it's crucial to invest in assets that are expected to generate returns that are larger than the inflation rate. Number 3. Debt repayment. Inflation can make it more difficult to repay debt, as more of your income will be required to meet the same debt payments. This might be particularly difficult if you have high-interest debt, like credit card debt. For example, consider a person who's taken out a $10,000 loan with a 5% interest rate and a 5-year repayment period. However, the inflation rate increases to 4% during the loan's duration. In this situation, the real amount due would be significantly greater than the $10,000 loan amount, affecting the individual's finances. Number 4. Retirement planning. Similarly, inflation can have a significant impact on your retirement savings. If you expect to retire in the future, you must consider the impact of inflation on your retirement assets and income. If the inflation rate's not accounted for, retirees may run out of money before they die, resulting in a substantial decline in their standard of living. Managing the impact of inflation. Even though inflation can't be stopped, there are still things you can do to lessen the effects of prices going up. Here are some things to think about. Number 1. Plan ahead. Inflation can be managed by having a strategic plan for managing your finances. List down your existing and future expenses. Create a budget that'll handle the expenses on your list, then adhere to it. This will prevent overspending and impulsive purchases. Number 2. Increase your cash flow. Consider ways to increase your income. The more sources of income you have, the more certain you may be that you have the finances to cover your expenses. You may want to look for part-time or online employment. Having your own business or side hustle is another way to enhance cash flow. Number 3. Reduce your expenses. Analyze your budget and determine whether a particular expense is necessary or a want. Find the optimal balance between your wants and needs in light of your available resources. If you believe that your money's limited, prioritize your needs. Practicing frugality would benefit from some discipline and effort. Number 4. Buy now or buy later. Many customers believe that it's advisable to purchase durable goods, such as fuel, oil, gold, silver, non-perishable foods, and other essentials sooner rather than later to avoid price increases. Some individuals may benefit from this strategy, but you should not spend on stocking up on products unless they'll retain their worth or function. Your money will not go as far as it did before inflation, so if you're considering a large purchase, you may wish to move up the date. Number 5. Start investing. Putting your money into investments with high returns and strong growth rates can help you deal with inflation. Some people put their money into individual stocks or exchange-traded funds to try to beat inflation by choosing companies that can handle or even benefit from the current economic situation. When inflation's going up, investors also tend to like commodities and precious metals like gold and silver. But every investment has some risk, and diversified funds tend to be less volatile than single stocks. You can also protect yourself from inflation by investing in things like I-bonds and other inflation-protected securities that'll either stay the same or go up in value during inflation. Talk to a financial advisor to help you figure out what the best investment strategy is for you. Inflation can have a strong impact on your finances. It's essential to monitor inflation rates and alter your financial planning accordingly, such as increasing your savings, selecting inflation-protected investments, and expanding your portfolio. By being proactive and taking steps to mitigate the impact of inflation, you can help ensure the stability and growth of your personal finances. That's it for today's video. Like and share the video, and don't forget to tell us the inflation rate of your country in the comment section below. Thanks for watching.